Unrivaled Nation, Flash, my AI assistant, called out Dlocal or DLO stock as its number one idea this past weekend, calling out its fast revenue growth, its hyper free cash flow expansion, along with hundreds of % upside. When I looked at the framework, it suggested that, the low case is around break even and the upside is potentially closer to 500, 600% upside. So I wanted to take a sort of a step back because, I'm the co-founder of Flash. The goal is to leverage these most cutting edge AI tools to help any investor in the world. And you could look up any company that you want for free. However, the premium, like best ideas and premium functionality, that does cost a bit, and the price is going to double on October 1st. So if you're interested, now's the time to check it out. So what we've been trying to do with Flash is to make the experience more automated, better for the users to get these reports. Because in my opinion, these reports are as if a junior investment analyst has written them up and made it possible for you. And so now any company in the world, you can get a report within 10 minutes, 10, 15 minutes about, which in my opinion, this is a game changer. It's a game changer in terms of productivity if you want to learn about new ideas. However, it is AI, so I'm like equally trepidatious to be like, okay, let's share this. So you need to have that understanding that AI can make mistakes. So in this case, I wanted to review like, okay, is AI going crazy with this, or does Dlocal actually have this type of upside downside? Because this is exactly the type of return profile that I like to find, which is on the low side you don't lose too much, and on the high side you can make a lot of money. That sort of asymmetry. The super short answer is that I actually think AI is broadly right about this. I might be a little less optimistic, maybe closer to 400% type of upside. And then the low case might be actually a little bit more optimistic, but that's just my, take as I look at this. Let's go through it so that way you can see the details yourself, what's going through it. You can see the report on Dlocal, once again, completely for free at Flash. So any company in the world that you're interested in getting these reports, you can, but you got to, remember it's AI, it's what we are leveraging the best AI models we can get to bring that to you. But it's, you have to use your own judgment as well. And so here it is. I'm going to use my own judgment, going through the framework in the years ahead. Personally, I think this is actually in the realm of reasonable possibility. So let's take a quick, step back before we, talk about the framework to understand, where does Dlocal go from here? And I should be, super transparent. I don't own any stock in Dlocal. I actually did previously a little bit, and I was turned off by some short reports. Things have changed a lot since then. I also did a video on it a while ago, and so I think my assumptions in that prior video were a little too aggressive to be 100% transparent. But let's focus on where we are today and think about what their business model is and where they're potentially going. So the way to think about it is if you have a business, an online brand, and first you might succeed, let's say, in the local market, in a local, maybe focusing on domestic markets or developed markets, and saying, hey, we're going to launch our products here. Maybe you're like a Nike or something like that, and you're selling your products online in the United States. Then you're going to say, okay, well, we want to expand to the rest of the world. What's the easiest way for us to do that? And then what you might look at is, hey, we're going to work with some international partners that are effectively gatekeepers that can then just run the processing, run basic credit cards for all these new international markets. Now, they may not have all the local infrastructure and all the local payment solutions and local knowledge to get the best payment approval rates to minimize fraud as a Dlocal. And that's what they're focusing on, which is specializing in the local payments for the largest emerging markets and adding various different payment methods. Because in each of these different markets, you're going to find, either different types of currency tools. Like in Brazil, they have PIX, a digital currency. And then it's about expanding to these tougher markets, these tougher emerging markets and frontier markets. And that's really where Dlocal is bringing value to these global brands, to these, brands that these online merchants that want to have global exposure, saying, we want to roll out to dozens of countries around the world. And in some cases, they might be hard for us to operate in. So we're just going to leverage sort of the payment, gatekeeping function to Dlocal, making sure that the payments happen and that, the approval rates are favorable. And so when you're looking at this business, I'm going to make myself disappear so it's a little easier to see. When you're looking at this business, they have a total number of merchants of around 800. The average number of countries served for their top 50 merchants are around 11, so just shy of a dozen. And so you can see these are the largest brands saying we want exposure to, let's say, 10 different countries that otherwise it's too hard or too much of a pain for us to do, or, we're able to get some sort of uplift in sales by using Dlocal. And then you could see there is a bit of, customer average number of pay-ins, payment methods. So that means for these different markets, they have 48 different payment methods that are offered. Now, that is a little bit of, an exaggerated figure in my opinion, because yes, you can say, hey, in Brazil, we have dozens of different solutions available, whether or not it's like buy now, pay later or installment payments and, that sort of functionality or Pix. But the reality is in each of these different markets, it's most likely going to be just a handful of core products. Maybe it's credit cards, maybe it's cash. Most likely it's going to be some sort of digital thing that's going to drive the majority of the transactions. But either way, Dlocal saying we've got you covered for these emerging markets and frontier markets. And so you could see the share of revenue by their top 3 markets. So this is predominantly in Latin America, is nearly 50%. So 3 markets is nearly 50% of their business, but then they have a bunch of other markets. That's the other half. And then they do have, I'd argue, some customer concentration that is worth paying attention to, where their top 10 is, around 60% of their business, a little bit more than 60% of their business. So, that is a yellow flag, because at any point, if you lose a top 10 customer, that means arguably you're losing somewhere between 6 and maybe 10% of your business, depending on how big of that customer is. So that could be a real headache. That could be a huge swing in profitability in any given period. It's not unprecedented for these changes to happen. And it's not the first time I've invested in a company that has that level of customer concentration risk, but it is something to think about as you go through an investment checklist in terms of thinking about potential blow-up risks. So, hey, you do have real customer concentration, risk. So their appeal is that they're bringing a lot of these local tools, as I already mentioned, to the merchants that help with that effectively helps with the sales process, such as having the Pix functionality in Brazil or buy now, pay later. They're not taking credit risks, so they're working with the local credit providers across these emerging markets. They describe themselves as a buy now, pay later aggregator built for high growth markets, offering the widest buy now, pay later coverage across emerging economies. So there might be other, fast growing, buy now, pay later in more, developed markets, but they think they're the fastest and the biggest for the emerging market, covering around 530 million users. And so this is an example where if you're able to translate into more revenue because more customers take this sort of installment payment approach, then you should be able to get a better fee for that. Now, there might be some uncertainties about stable coins, saying, hey, is this potentially going to be an erosion of their business long term? That's an uncertainty. I personally view it at this point as a lower cost rail. Let's say credit cards are an expensive rail to transact on. Maybe if you're using more stable coins in the future, that might be a lower cost, rail. But either way, this approval process, detecting fraud, that's a minimum, performance, arguably a critical service that even if your cost structure is going down, I still think they're going to be able to charge for some of this core functionality over time. And that is important to recognize. And we're going to talk about take rates in just a second. So, you do have, this is what they're talking about, that we're making it possible for stable coins because that's been a push by the current U.S. presidential administration. And then also we're, making various different localized, payment functions available. And you can see how all these initiatives translate into their results. They're talking about fantastic total payment volumes, up around 50% year over year. If you adjust for constant currency, up closer to 65%, revenue up closer to 50%. You could see huge growth in free cash flow, up 150%. So a lot of favorable developments as you're looking at the results here. And not only are they posting strong results, but they're raising their guidance for 2025, what was previously 25 to 35%, revenue growth for the year. They're now expecting closer to 30 to 40%, and adjusted EBITDA up closer to 40 to 50% versus 20 to 30% the prior year. Now, there are some key risks that investors need to be mindful of. I think saying that their markets are inherently volatile, that's almost an understatement given, sort of the neighborhood and where they operate. And you can have volatility with these different currencies, with these different regimes, with trade policies. So, and then layer on customer concentration. So this is just there's a lot of risks here that investors need to be mindful of. One common pushback I've heard and seen is about take rates, suggesting that over time the take rates have come under a lot of pressure. Maybe they keep going lower. I am not really focused on the take rate argument when I'm thinking about this business. I'm really thinking about, are you taking share? Which clearly they have. Clearly they're taking share and crushing it this year. But there's going to be a lot of moving parts that can influence the take rate, such as the underlying business in which Dlocal is providing. There might be mix issues that result in effectively lower fees that they're able to charge. Maybe different countries also have different take rates that could, cause take rates to go lower over time as well. You could have they talk about the effectively businesses where they're collecting money from consumers versus business where they're transferring money from business to business. They're going to have different fee type structures for their business. So I'm once again less focused on potential take rate pressure, more focused on, is their underlying gross profit, is their underlying revenues suggesting that they're taking market share over time. Even, and one could argue the lower the fees, sort of the faster the flywheel you get, where you could say, yeah, we're able to lower the fees, provide all this great service, the buy now, pay later options, all that, and thus we're going to be able to take market share even faster. So there definitely are business models like that. So it is important to recognize it may not just be a race to the bottom. It may be we lower fees so that way we can dominate, in these emerging markets and frontier markets, long term. So that is important to think about this. So is this AI madness, or is this actually possible? As I already said, I actually do think this is the realm of possible in terms of the framework, in terms of how it, the possibilities for it in the years ahead. But I want to, walk through the details, of how I'm thinking about that. But first, as always, none of this is financial advice. I'm just sharing my personal thoughts. I don't own a stake in Dlocal at this time. And just yesterday, Mohammed D., he's a subscriber to Unrivaled Investing. He wrote, "I've been a member of Unrivaled Investing for over a year now, although the positions you have covered have more than covered the membership." So he's, the companies we've talked about have, fortunately fully more than covered the subscription cost to him. My ROI, or return on investment, is what I've learned through your weekly letters. So Mohammed, I'm really glad to hear you're enjoying Unrivaled Investing. He was thinking about upgrading to the premium tier, and that's because the premium tier, the rate will be going up significantly in October. So if you are interested, the premium tier covers our exclusive Discord, where I'm interacting with members on a regular basis, answering questions, covering companies sort of in real time, where I'm, looking at news and that sort of stuff. So it's for the folks that, want the extra dose of unrivaled investing, or they want to see, sort of the process as I sort of break down companies in real time. Maybe it's an earnings release, going through these components. So let's keep going in terms of what's going on with Dlocal. So, this is once again from Flash calling out the risks. This is spot on. Emerging market volatility in terms of either what's going on with the economies there, the politics there, or the potential currency devaluations. These are major risks for Dlocal that will create volatility in their results. I think that is a certainty over time that you will see this. Another key aspect, as I've already called out, is the client concentration. One would hope, if you're a Dlocal shareholder, that you will continue to have their top merchants and that they won't lose any. If anything, they'll keep, diversifying and growing more customers over time. But that is a real risk that 1 quarter, 1 year, they announce, hey, 6% of our revenue's going to disappear. And you could see the dynamics of the volatile markets that they operate in just by looking at, how gross profit was performing in the most recent quarter. Brazil absolutely crushing it. They're talking about volume growth, higher share of installment payments. However, you can look at a country like Egypt, another, emerging market that they're operating in. And, keep in mind, they operate in literally dozens of countries around the world that are difficult for these major brands to operate in, get exposure to. And that's their value proposition. And they talk about partial volume loss due to a large merchant implementing redundancies, i.e. they might say, hey, there's another service provider that we're going to use. And then they also had foreign currency devaluation that was also creating pressure for them here. So these are real challenges that they're going to face. It's not always going to be a great year like you're seeing in 2025. 2024, there was a confluence of events that arguably spooked investors. You had Argentinian currency normalization. You had take rate pressures that I've already talked about. They had an offboarding of a large merchant / payment processor customer. That resulted in revenue growth decelerating significantly to, a teens rate. You see gross profit only up a couple percent. Adjusted EBITDA actually declined year over year. So this is the type of noise that I think investors should expect. You shouldn't. This is not the type of business where every year it's going to be up and to the right. This is going to be the type of business I suspect will be higher over time, but it might be, a lot more zigzag, a lot more this, oh my goodness, what's going on in Brazil? And then Dlocal stocks down 5-10%. Oh my goodness, they just lost this customer. Dlocal's down 20%. Oh my goodness, they just posted a up 50% payment volume. Dlocal's up 30%. So you're going to have that type of volatility. Investors should be prepared. I think when you understand and look at this company, looking at their valuation, currently around $4 billion market cap, net of cash, it's actually closer to $4 billion because they do have a net cash balance sheet. Plugging in their 30 to 40% guidance of revenue growth. So talking about around $1 billion in revenue, thinking about margins, somewhere mid 20s, they've already proven that they can do it. So you're really talking about a company trading around 20 times earnings, which is actually, in my opinion, very interesting. Now, keep in mind, this is a hypothetical framework. Stock prices go higher or lower, depends on execution, depends on external events, like what happens if Brazil does some crazy, money printing or something like that. So what happens in the local elections? So there's all sorts of things that can happen. It's important to be mindful of that. But just on the face of it, there are not very many companies. There are not very many companies that are growing at 30% plus, trading at 4 times price to sales. So that is something that gets me interesting, trading around 20 times, earnings. So I look at this and I go, this actually is pretty interesting. So then the question is, well, what do you think their growth rate could be in the years ahead? What do you think their revenue growth could be? Recognizing that it could be bumpy. It's not going to be every year of 30 to 40% type of growth. At least I don't think it will be, even though they're tapping into a large, market opportunity in emerging markets and international, where they think there's just huge headroom, huge potential for them to grow. So I'm thinking over the next 5 years, this is on a per share diluted basis, I'm penciling out somewhere between 12 and 24%. This 24% might be too high, frankly, but thinking about 12 to 24%, that's what I'm penciling out. Based on that growth rate, you might have a wide range of how investors think about the earnings multiple. If you're closer to that 12%, maybe you've had some volatility where 1 year was great, another year you lost a major customer. Then it wouldn't surprise me if you're trading closer to 15 times earnings 5 years from now. So a lower, further valuation compression. And then there's another scenario where they absolutely keep crushing it. They keep taking market share. They keep their largest customers. They're growing very rapidly. They're expanding their profit margins, in which case they're trading at 30 times earnings, maybe even more, arguably, if they really have this type of execution. Investors worry less about emerging market risks. I mean, you could have that type of period. It's human nature. Studying history, it is definitely human nature to go the love-hate relationship with emerging markets. You will absolutely see that full cycle play out, in my opinion. And so, in peak love, you could arguably get even higher multiples than this, in which case, just running through this math, you could see a scenario where, yeah, it is up closer to that 400, 500%. And the, downside might be compounding at around 4% because there is real free cash flow that they're generating here. On that point, the free cash flow, in my opinion, is pretty interesting because on a recent conference call, management was calling out, yeah, we're expecting to keep generating this free cash flow. So we're going to return roughly 30% as a dividend going forward in 2026. I view that as another favorable potential catalyst for Dlocal stock as investors start saying, hey, this is a stock that really started initiating a dividend. They had a one-time special dividend recently, but having a regular cadence of, they say, hey, let's set that 30%. That would be about a 1.5% payout ratio currently, 1.5% dividend yield, I should say. So that's kind of interesting. They talked about how they wouldn't do buybacks because they didn't really like the float and not enough shares outstanding. I thought personally that there was a little bit of malarkey there, and that with the share price where it is, it definitely makes sense for them to buy back if they really think they're going to be growing over time. But overall, this is favorable initiatives that they're taking towards shareholders with dividend policies. I'd argue a favorable valuation. The question is really around that growth, saying, hey, how confident are you that this business actually will be much larger in the future and that there won't be some either competitive risk that hurts the business, resulting in slower growth, or some sort of merchant churn where one of the largest players say, hey, maybe we should use some other player, or we can figure out some other solution, or maybe it's from some sort of stablecoin aspect that create a risk. So that is the uncertainty about the obvious growth. Something to think about, though. Overall, I'm impressed with how AI actually got this largely right. I'm sure there are going to be plenty of reports where it misses the mark, and I welcome your feedback on that. I hope this video has been helpful for you. Thanks so much for watching Unrivaled Investing.